Welcome back, focused learners, to another explainer. Today, we're tackling something that has literally been one of the most highly anticipated arrivals in the entire Cardano ecosystem. For a long time now, Cardano has been relentlessly building out this incredibly robust, secure foundation. We've seen the major upgrades, the new decentralized apps launching, and a steadily growing community. But as the DeFi space expands, there's been this glaring missing piece, a massive one actually: risk management. Seriously, you can have the absolute fastest transactions and the most unbreakable consensus mechanisms on the planet, but if there's no safety net, well, financial growth hits a hard ceiling. So today, we are breaking down the arrival of the very first insurance solution designed specifically for Cardano DeFi. And let me tell you, this isn't just some cool new app. This is a massive structural milestone. It's the kind of thing that could fundamentally alter the network's landscape, totally shift how capital moves around, and frankly unlock a whole new era of participation. So let's get right to it. Okay, let's dive into this because we really need to acknowledge the harsh reality of decentralized finance. The truth is, most people play it safe because one crash can wreck everything. If you're out there interacting with smart contracts, you already know the extreme stakes we're talking about. Imagine this, and maybe you've been here. You spend hours doing deep dive research on a promising new liquidity pool or lending protocol. You finally deploy your hard-earned assets, expecting a nice, solid yield. And then you wake up one morning, open your wallet, and boom, it's just gone, completely drained. Whether it's a subtle little bug in the smart contract code, a flash loan attack out of nowhere, or just sudden impermanent loss from wild market swings, that fear of losing it all is so incredibly real. And you know what? That underlying anxiety is paralyzing. It keeps so much capital just parked on the sidelines, literally sitting in cold storage instead of being actively deployed to generate value. And honestly, you can't blame users for hesitating. When the environment feels like the Wild West, where one single bad click or unseen vulnerability wipes out months of gains, extreme caution is just the logical default strategy. But that exact hesitation is what's holding DeFi back from really competing with traditional financial systems head-on. Well, enter the ultimate solution to that paralyzing fear. It's called Aegis. Developed by the incredibly sharp team over at Flux Point Studios, this brings us the very first insurance tool built entirely natively on the Cardano chain. Basically, they're giving users the ability to finally, as the developers put it, shield up. Now, you might be wondering, what does being built entirely on the Cardano chain actually mean, and why is that such a big deal? See, in the past, a lot of crypto insurance models actually relied on off-chain promises. We're talking centralized entities holding funds in a traditional bank, dealing with the exact same red tape, legal delays, and failure points we're all trying to escape in the first place. Aegis completely flips that paradigm. This is native, on-chain insurance. The policies, the capital pools, the payout mechanisms, the whole shebang lives and breathes directly on the Cardano blockchain itself. So instead of just crossing your fingers, holding your breath, and hoping for the best when you interact with a new protocol, Aegis steps in to fundamentally change how we manage risk. It brings a layer of sophisticated financial tooling that lets you calculate your exposure and proactively hedge against those exact nightmare scenarios we were just talking about. So the crucial point is how this automated mechanism actually works behind the scenes. For the end user, it is honestly wonderfully straightforward. It breaks down into a super seamless process. First up, you just buy a policy to secure your specific position. Maybe that's a liquidity pool pair, or maybe it's a collateralized loan. Once that's done, the network's oracles take over. Now, if you're not totally familiar, just think of oracles as highly secured data feeds. Remember, blockchains are basically isolated bubbles. They don't natively know what's happening in the outside world or even on other protocols unless someone tells them. Oracles bridge that gap. They constantly monitor activity and feed unalterable data back into the smart contract. So let's say you've got a policy protecting you if a stablecoin depegs below 90 cents. The oracle is watching that specific price action like a hawk. If that depeg happens, the oracle detects the exact failure conditions, and boom, it automatically triggers the payout. Since the calcal comes straight from a pre-funded liquidity pool, the money hits your wallet instantly the second those conditions are validated by the network. There's no waiting for some human at a desk to review the event. The data speaks, the smart contract listens, and the execution is absolute. No claims, no delays. I really want you to let that sink in for a second. And this brilliantly illustrates the massive advantage of on-chain risk management. Think about your typical real-world insurance experience. Endless bureaucracy, mountains of paperwork, waiting on hold for hours, the agonizing friction of waiting weeks to see if a human adjuster decides your claim gets approved, or if they're going to deny it based on some obscure technicality buried on page 40 of your contract. Aegis just literally deletes all of that friction. Why? Because it's entirely deterministic. Not deterministic is a big word, but it just means the system relies purely on math and immutable code, not human opinions, not corporate profit margins. The outcome is predetermined by the logic hard-coded right into the contract. If the negative event happens on-chain and the oracle confirms it, the code executes automatically. You are covered immediately. Period. No adjuster scrutinizing your actions. No annoying under-investigation emails clogging your inbox while your portfolio burns. It is the purest, most efficient form of risk transfer imaginable. Let's move to and see how this builds into something much, much bigger. Because the impact of Aegis goes way beyond just protecting an individual's wallet. When we zoom out to look at the macro benefits for the entire Cardano network, the ripple effects are absolutely huge. First off, by cutting out that paralyzing DeFi fear we explored earlier, the psychological barrier to entry plummets. With that hesitation completely removed, the logical expectation is that capital should start aggressively flowing into liquidity pools and lending protocols. More confidence naturally leads to more participation. And that brings us directly to TVL, or total value locked. TVL is basically the ultimate macro metric used to measure the overall health and scale of any DeFi ecosystem. It's the total amount of user assets actively staked or locked into decentralized protocols. When fear subsides and capital flows freely, TVL stands to benefit big time. That makes the whole chain drastically more robust and a lot more attractive to massive institutional players. Plus, there is this incredible sustainable bonus baked right into the system. Aegis actually sends a cut of its protocol fees straight back into the Cardano treasury. It creates this beautiful, self-sustaining loop. The application provides the critical security needed to grow the ecosystem, and as it succeeds, it directly funds the treasury that supports the ongoing development of the network itself. Honestly, this kind of determinism, efficiency, and security is exactly what the Cardano ecosystem needs right now to mature and truly thrive. We are moving so fast, rapidly past the experimental phase of crypto, and we're entering an era where sophisticated, reliable financial infrastructure is absolutely mandatory. And the tools are finally here. If you're actively participating in these markets, the mandate is pretty clear: shield up. So I want to leave you with a final provocative thought straight from our source material to consider for your own personal strategy. Now that you finally have the power and the infrastructure to manage risk without relying on a centralized middleman, would you buy coverage for your LP positions or loans? Seriously, think deeply about how fundamentally that capability changes your entire game plan. Thank you so much for joining me on this explainer today. Keep learning, stay focused, and I'll catch you on the next one.